Firstly, good morning, everybody. Thank you for joining our budget briefing webinar. Quite a lot to talk about. Obviously, it would be better if we were all doing this in person, but unfortunately, we still can't do that, but hopefully that will all change soon. As you can all see, I'm actually in the office, so hopefully no pets or children will interrupt me. Because I was on 2 Zoom calls this week and one client's cat kept going across the screen, and then on another Zoom call, a young man burst into his father's study dressed head to toe with Spider-Man. So that was obviously a bit of hilarity, but unfortunately you're not going to get that today. Anyway, without further ado, let's see what the Chancellor said yesterday. Right, so the background to this budget is obviously clearly very, very different to ones we've had for many, many, many years. It's against a backdrop of COVID, the pandemic, which is still ongoing, the need to repair the public finances. And also there's a slight political slant here about maybe the Tories saving that red wall that got them into power with some of his measures. It'd be interesting to see if we could go back in time without the pandemic to see the 2 budgets that the Chancellor would have presented, including yesterday's, given there was lots of talk of making the UK as attractive as Singapore. Clearly that's pretty much off the agenda now. But let's see what he had to say. In terms of the public finances, the UK is set to borrow nearly 400 billion this year, which is significantly higher than the year before. It's a peacetime record and it represents 17% of GDP. But we're not alone in that. Most economies around the world have had to spend significant amounts of money to keep the economy going, to support people through this pandemic, which has been worse than I think everybody anticipated when it all started and all kicked off last March. I must admit, I was one of those people who thought, well, this will all be done by the summer. What is there to worry about? Clearly, there was a lot more to worry about. The Chancellor announced continued support for people and businesses throughout the pandemic. Some of this had already been flagged up pre-budget. Obviously, the furlough scheme, where the government picks up the tab for most of employees' wage costs for businesses, was due to finish, but it's been extended yet again to 30th of September. However, in July and August and September, in those 3 months, employers will need to make more of a contribution to the cost of providing support to their employees. He announced more grants for the self-employed, and also more self-employed people, around about 600,000, will be eligible for those grants. This is because to get one of those grants initially, you had to have filed your self-assessment tax returns, etc. And a number of people who'd recently just started as self-employed hadn't done that and weren't eligible. We've now gone through another personal tax cycle. Those people have now filed their self-assessment on a self-employed basis, so now can access that support. He also announced what he calls restart grants from April for businesses as they come out of lockdown. They range from £6,000 to £18,000, depending along the timeline of when you can actually come out of lockdown and start opening your businesses. So the larger grants will be there for hospitality businesses, gyms, etc., because they're some of the last businesses that will come out of lockdown and can open their doors. He also announced a recovery loan scheme for amounts between £25,000 and 10 million, which will be backed 80% by the government, and that's to replace bounce back and CBILS when they come to an end. Also, the business rates holiday has been extended to the end of June, I should say 2021. not 20, apologies. And then after that, it will go down to 2/3 relief. If you recall, to support hospitality businesses, etc., in that sector, VAT was significantly cut, 5%. That will now stay until the 30th of September. And he's also given some interim relief up to the 31st of March 22, when it'll be 12.5%, but thereafter it'll go back to the standard rate we had before of 20%. As we're all aware, there was a stamp duty holiday, which was due to finish at the end of this month, but there have been so many people taking advantage of the savings that they just can't get all the transactions completed. And it was the end of this month was turning into a bit of a cliff edge for people. In recognition of that, that's now been extended to the end of June, and also a partial relief of 250 as a nil rate band rather than £500,000 will be in place until the 30th of September. Hopefully this will enable people to get all the transactions done, but equally it is a further boost to housing, to people buying houses. And that's perceived as good for the economy, because when people move house, they're spending money, they're buying new furniture, they're tarting it up, buying curtains, what have you. So welcome news for people moving home. Personal taxes. The triple lock remains. As I'm sure you're all aware, the Tory party manifesto promised that there would be no changes to income tax, pensions, etc., which is the triple lock. There was some talk in the press that they would actually break that manifesto promise to have to deal with repairing the public finances. However, that stays in place. Personal allowances normally rise every year in line with CPI, inflation, whichever measure, and they were due to increase over the life of the Parliament. However, what is decided is that whilst they will go to the rates that have been previously published from April this year, so the tax-free amount you can earn before you pay any tax is going to go from £12,500 to £70 more. Perhaps you can buy a stamp. And the higher rate threshold before you start paying tax at 40% is going to go from 50 to 50,270. However, these are going to be frozen until 2026, which is quite a long period of time, 5 years. Now, what does this mean? It's called fiscal drag. That basically means more taxpayers will be dragged into paying higher taxes because the bands at which they pay tax are frozen and don't rise as wages rise over time. The estimate is that will mean about 1.3 million people being dragged into the tax net or a higher tax net. And it's estimated or forecast by the Treasury that will collect an extra 19 billion by 2026. We're all aware before this budget, there was an awful lot of speculation. If you remember, the Institute of Financial Fiscal Studies released a report that, was basically everything's going to be changed. IHT is going to be scrapped. We're going to have a new wealth tax. Capital gains tax rates are going to be aligned with income tax rates, etc. I certainly know lots of planning took place before yesterday for people to do transactions to capture the existing rates of capital gains tax, etc., on the back of an expected rise. None of that happened. So whilst I'm not saying that planning was wrong to do, clearly it wasn't, because if it had gone up, people have been kicking themselves. However, there are going to be consultation documents coming out, and potentially those taxes will be looked at again, because certainly there are some reforms coming, but we'll need to wait and see what the measures are, or the proposed measures are, at a later date. One thing they have changed, a small point, but pertinent to some people, is there's a tougher penalty regime going to come in for late tax payments. At the moment, if you don't pay your personal tax by the 31st of January, fine, bit of interest. But if you're still not paid it by the end of Feb, there's a 5% surcharge. In essence, that's increasing to 6%. However, he's foreshortened that time frame so that if you've not paid your tax by the 16th of February, you're going to be hit with a surcharge. So people will need to be a bit quicker, getting their personal tax information together and paying their tax and filing their tax return. However, for most people, that's not going to come into place until the 6th of April 24. This was the really interesting part of the budget. Although businesses, I think most corporates, most companies knew that something was on the cards. So what he's announced is that the current rate of corporation tax, which is 19%, will now only apply to small profits defined as £50,000. There'll then be a top rate of 25% for profits of £250,000 plus, and in between those two, there'll be a tapering regime. Also, an added sting in the tail is that the associated company rules will be reintroduced. If people can cast their minds back, if you had companies with common shareholders, etc., then those bands were divided amongst the number of companies. Now, if you're a group of companies, then you're probably, the impact is going to be lessened, because if you've got one company in the group with profits and one with losses, you can group relieve those to minimize your tax bill. However, if they are associated companies, not in a group, you can't do that. So this could have a real impact. 25%, I must admit, took me slightly by surprise. I was expecting something around about 23, with then maybe a gradual increase. We have historically had much higher rates. It wasn't so long ago that our rate was 28%, and it was even higher way back when. When the Chancellor did say it still leaves us with one of the lowest corporation tax rates in the G7. That's true. And in fact, across the pond, Joe Biden has signaled that he will effectively reverse the corporation tax cuts that Donald Trump introduced. So the movement of travel is upwards. And I would imagine it will be the same across the board as governments seek to raise further funds to repair the balance sheet following the pandemic. To possibly soften the blow on the increase of corporation tax rates, he's introduced a new regime, a temporary regime, I have to say, for the use of losses. Presently, a company can carry back losses from its current year back 1 year. That effectively stays the same, and that is an unlimited carryback, depending how big your loss is and how big the profit was the year before. But clearly, many companies have incurred significant losses during the pandemic. And to help them get some relief for those, he's extending a period for accounting periods ending between the 1st of April 20 to March 22, that you can actually carry back 2 years. So you've got an unlimited carryback to the year before as normal, but then you can also carry back losses to the 2 earlier years before that, up to a maximum of £2 million per year. Again, for groups, they will need to apportion that 2 million limit as they choose amongst each group company. However, there is a slight gain for the Treasury. So while that means lots of companies are going to carry back their losses further and really and get tax refunds, those refunds are in essence at 19% because that's the rate at which they paid those earlier years' profits. But if it means you then have used up all your losses, you haven't got those losses to carry forward against future profit. And as I've just mentioned earlier, those future profits are going to be taxed at 25%. So actually there's 6% differential there. So whilst it's a bit of a giveaway, again, there is a hidden sting in the tail to that in terms of the value of those losses. You don't have to obviously carry back those losses. You could leave them to carry forward and shelter your profits at 25% going forwards. But I would imagine most companies will take advantage of this because that's going to ease cash flow, which has no doubt been under significant pressure. So that's a relief for companies. And the Chancellor is doing essentially the same thing for unincorporated businesses such as sole traders and partnerships. There are currently anti-avoidance rules that stops you, if your partnership makes trading losses, you can set those against your other income, general income, total income. Those sideways loss relief rules restrictions of 50,000 or 25% of total income, whichever the higher, that stays in place. That is untouched. However, the rules are changing in terms of carrying back losses against profits from the same trade. The current rules are you can carry it back against the prior year, unlimited. Again, they stay the same, just as with companies, but he's allowing any losses incurred in the 2021 tax years and 21-22 tax years, again, those years most likely affected by COVID, you can now carry back against profits of the same trade going back 3 years. So you've got the prior year unlimited, and then the next two, just as the same as the company rules I've just outlined. And once again, they're capped at £2 million. So I think that's valuable. That will help an awful lot of people and generate significant refunds for those whose businesses have been badly affected by COVID. The Chancellor has said in a number of pieces in the press, etc., that turbocharging the economy is important, and what he wants to do is stimulate investment by businesses, companies, etc. The general feeling is there's an awful lot of pent-up demand, not just by consumers, because we're all desperate to go back into restaurants, see our friends, have a drink, and have a nice meal out, but also corporates and businesses are also got quite a lot of cash, hopefully, to spend once they're able to. That might be a temporary boost because once that's spent, things may normalize. But to stimulate investment, he is basically, the annual investment allowance, as probably most of you know, is $1 million. It was due to drop down to 200,000 at the end of December. So basically, he's rode back on that drop back to 200,000, and he's put it back to $1 million. So that will be in force for expenditure from January this year to the end of December this year. As you all know, annual investment allowances, you can't spend them on certain assets. Primarily, it doesn't apply to cars. So he's hoping this measure will stimulate businesses to spend more, invest more, which boosts the economy, etc. Interestingly, he's introduced a further measure to boost investment in the economy. He's introduced something called the Qualifying Capital Asset Investment Relief. They always have catchy names that are very easy to remember, don't they? Now, this only applies to companies on expenditure spent on plant and machinery. Now, this is based on the investment taking place between April of this year up to the 31st of March 2023. So there's a 2-year window to obtain this additional relief. And as the Chancellor called it, it's a super deduction. It's a super boost to capital investment, such that if you spend £100,000 on plant and machinery, you're going to actually get a deduction of £130,000 against your taxable profits. That's for stuff that would fall into your general pool, i.e. stuff that presently would benefit from an 18% writing down allowance. However, people spend expenditure on things that don't go into the general pool. And for those things that are called special rate, which would be things like long life assets, integral features, that is going to be 50% super boost relief. Importantly, the plant and machinery that you purchase, it must be new. It can't be used or secondhand. And I think in a slightly mean way, he's actually excluded expenditure from this relief if it was contractually entered into prior to budget day yesterday. So for companies who have pre-budget day entered into a contract to buy a great big printing press, irrespective of the fact that they're actually not going to spend the money until after April this year, they will be excluded from the relief because there was a contractual obligation prior to budget day. No doubt there'll be reams of what that actually all means when we actually see the draft legislation and the detail. The flip side of the super boost 130% allowance is that if you've taken advantage of that extra tax relief on acquiring your plant and machinery, when you come to sell it, what you sell it for, your disposal proceeds will need to be increased by a factor of 1.3. So that effectively matches the relief you got at the start. So your disposal proceeds will be enhanced by that uplift, which possibly say that's fair. We had some super relief on the way in, and we've got to super up our proceeds on the way out. What are the other things that he talked about? He talks about creating 8 free ports around the country, some in the south, Solent, some in the north, Teesside, etc. Hence my red wall comment at the start of this presentation. And as most of you know, a free port will benefit from certain tax breaks. It will benefit from 100% allowances on building a warehouse in a free port, for example. And also you're not subject to import duties. So you can bring goods into a free port, no duties are imposed, bringing it in, no import duties, and you can then ship it out again. There are quite a number of these around the world, and the Chancellor's hoping that they will provide a boost to those local economies where the free ports will be located, again, generating jobs, etc. in those locations. He also mentioned that part of the Treasury, of which he heads, will be moving to Darlington. I don't know why he picked Darlington, but again, it's a shift of a base of power to the north, which I think is a really good thing. I think it's a real shame the House of Lords didn't end up relocating to York. I think that would have been good. So yes, I don't know why he picked Darlington. I can't actually see the Chancellor moving to Darlington. I think he's more got his eye on moving next door to number 10 at some point. Also, he's recognised that pubs form an important part of local communities, especially in small villages, etc., where it's a bit of a hub for the community. So people can now club together, buy their pub if it's like closed down in their village. Happy days. I once acted for the owner of Derby County Football Club. This is way back in the years when football clubs were owned by a local businessman made good, as opposed to a sovereign wealth fund. And he liked his local so much, he bought it as well. Enterprise management incentives, which I'm sure most of you know are a tax advantaged share option scheme used to either attract talent or retain and motivate key employees who are already in the business. Now, to take advantage of that, you need to actually work full time as defined for the business. Now, he's recognized that for many people who have these options, may well have been on furlough. They haven't been working, so they would not meet the full time working requirement. That would have been a disqualifying event. He's recognized that and basically said furlough won't impact on the eligibility of those. As I said, what the Chancellor announced yesterday is that there is going to be a raft of consultation documents being issued. He said on the 23rd, and those consultation documents will no doubt cover some of the things we've chatted about, the future direction of inheritance tax, capital gains tax. He specifically mentioned he would be looking at EMI. There was some talk in the press, if you remember, that they might scrap EMI because it's too generous, and also looking at R&D tax relief. We proudly bang on about wanting the UK to be a hotbed of innovation. We've got patent box R&D. Some of that was previously restricted because it was notifiable state aid, and because of EU rules, we had to kind of water it down. I'm wondering whether now that we've actually Brexited, that those restrictions don't apply and you can actually make it more generous. However, there is legislation coming into force from April this year. It was meant to come in from last year, so this isn't new stuff that he announced yesterday. But I think it's an important point just to make, is that in relation to the R&D tax credit, this is where a loss-making company is able to sell its losses for a tax refund, cash refund from the government. He feels that's possibly been, there's too many people taking advantage of that with outside of the spirit of the law, where they just set up a UK company, one employee, and all their research is actually subcontracted to a different jurisdiction. And then they basically generate a big repayment of tax from the UK exchequer. So the rules that he was going to introduce last year are now going to come in force this year. And basically the repayable credit will be capped at 3 times the UK company's pay-as-you-earn and national insurance contributions, i.e. To 3 times that amount plus £20,000. So in fact, your refund is funded by what you've paid out in pay-as-you-earn and national insurance. So that's going to mainly impact companies with a small UK presence who subcontract out most of their R&D to India, for example, but equally companies with a small workforce who perhaps expend an awful lot of money on consumables as part of their R&D activity. So in summary, what are the kind of key takeaways? Hopefully there are some from what I've said, by the way. Most people, most businesses and individuals, I think will be a sigh of relief that the support measures have been extended and indeed in some areas enhanced. Clearly the right thing to do. The pandemic is still with us. A vast swathe of the population still haven't had their first jab, never mind their second jab. And the route out of lockdown previously announced by the Prime Minister, whilst that's penciled in for the 21st of June, and let's all really hope that happens, we'll have to see how it goes at each of those stages. We're clearly, not out of the woods yet, and we've also got to contend with various new variants of the virus, and we don't actually know the efficacy of the vaccines we've already got to combat that. So that's welcome news. Personal taxes really broadly untouched. Yes, he's frozen the personal allowances, so more people will be dragged into becoming taxpayers or paying at a higher rate. But it's nowhere near the fears and concerns and worries that people had pre-budget. he's introduced a number of measures to hopefully boost investment in plant and machinery, etc., and equipment for businesses, in terms of not reducing the annual investment allowance back to 200, but keeping it $1 million for another year, and also the new 130% super boost capital allowances regime. Tax relief for losses, I think that'll be fairly welcome. Like I say, extending the carryback to 3 years for both corporates and unincorporated businesses. But as I said, for companies, there is a slight sting in the tail, because that means you've used up all your losses, got your refund at 19%, but that means you'll be paying more profit going forwards at the new rate of 25% if your profits are £250,000 plus. Whilst that is a big measure, and I know many corporates will be kind of going, "Ooh, crikey," it actually only raises 8% of all tax, corporation tax, surprisingly, lower than I actually thought. Where does tax primarily come from? That comes from pay-as-you-earn and national insurance. And that's predicated on businesses hiring people, employing people. And so really, that's why there's been a focus on jobs, etc., furlough, etc., because this is all about boosting jobs, boosting employment, because that will ultimately lead to higher pay-as-you-earn receipts, higher national insurance receipts. And that's where the focus is, because that's going to raise the most amount of tax. So an interesting budget. We did have a little bit of a throwaway as normal, that they're going to continue in tackling tax evasion, which is going to raise billions of pounds, and it never quite does. Some interesting measures, but I think overall it wasn't as bad for a lot of people as people suspected or feared. And certainly I know that report I mentioned earlier from the Institute of Fiscal Studies, really put the wind up many people, and they thought it was going to be an Armageddon scenario. That's not happened yesterday, but it might happen in the future. And like I said, once they start issuing all these consultation documents, we'll have a clearer picture of what they're going to say. And of course, we at KJG will be issuing blogs, e-shots, etc., to keep everybody aware of any proposed changes. So that was me, Alex White, partner at KJG, which is a Zinedine Group business. Hopefully, you found that informative. Clearly, it is only a skim through the points that the Chancellor made yesterday. And as the actual draft legislation comes out, we'll be reviewing that and keeping everybody posted on what it means for you and your business. So hopefully you found that informative. Hopefully you didn't get too bored listening to my voice, but I think there might be some questions. Any questions from anybody? Julian Barassi has asked about the purchase of vans. Does that qualify under the plant and machinery enhanced allowances? It specifically excludes cars. What's a van, what's a car is an interesting concept. Certainly if it's a lorry, then it would be qualifying, as opposed to not qualifying. There were some press releases out last night about looking at the regime for benefits in kind on vans and cars, but again, that was just tinkering with it and increasing the rates, etc. Well, thank you, everybody. Hopefully you've got some takeaways from what I've just talked about. It's been a pleasure to, I don't know what to call this, remote speak to you, see you, meet you, etc. And hopefully before too long, we can do that in person. Thank you.